Hi everyone, welcome to my channel InfoCraze, your go-to channel to learn accounting and finance in the simplest possible way. If you are preparing for a finance job interview to take up roles like financial analyst or corporate finance executive, then this video will be helpful for you. It's not just about memorizing answers, it's about understanding the language that finance professionals speak every day. Now let's get started. So today I will walk you through some important terms that you need to know before stepping into any finance job interview. The most common term that is used in finance is revenue. So what is revenue? Revenue is the total amount of money earned by a company from its normal business activities like selling goods or providing services before deducting any costs or expenses. If you look at the definition closely, there is a mention of normal business activities. In accounting, revenue refers specifically to the money earned through a company's core or normal business activities. Revenue does not include things like interest income or investment gains unless that's the company's core business. In simple terms, revenue is equal to quantity sold into price per unit. If a bakery sells 10,000 cakes in a year at Rs 500 each, then revenue is equal to 10,000 into Rs 500, which will be equal to Rs 50 lakhs. As revenue is earned from normal business activities, that's why for a bakery, revenue is from selling cakes or bread and not from selling an old oven or earning bank interest. Next, we look at the types of revenue. Operating and non-operating revenue. Revenue earned from a company's core business activities is called operating revenue, whereas revenue earned from activities that are not part of the company's core business operations is called non-operating revenue. Let's look at some examples of operating revenue. For a retail shop, it is the sales of goods. For a consulting firm, it is the service fees. Some examples of non-operating revenue are interest earned by a company on bank deposits or rent received from rent-out properties. Next, we look at the term EBITDA. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. It measures a company's core operational profitability by excluding non-operating expenses like interest, taxes, and non-cash charges such as depreciation and amortization. In simple words, EBITDA shows how much profit business makes from its main activities before considering financing costs, tax impacts, and accounting adjustments. Thus, EBITDA is equal to net profit plus interest plus taxes plus depreciation plus amortization. Since net profit plus interest plus taxes is equal to EBIT, that is why another definition of EBITDA is EBIT plus depreciation plus amortization. Next term we look at here is net profit. Net profit is the final profit a company makes after subtracting all expenses from its total revenue. In simple terms, net profit is equal to revenue minus all expenses. That includes cost of goods sold, operating expenses like salaries, rent, etc., interest on loans, taxes, depreciation, and amortization. Now we look at the term working capital. Working capital of a company is the excess of current assets over its current liabilities, representing the funds available to meet its short-term financial obligations and day-to-day operations. Thus, working capital is equal to current assets minus current liabilities. Positive working capital means the company can easily handle short-term expenses, whereas negative working capital can be a warning sign of financial trouble. Now let's look at the term cash flow. Cash flow refers to the movement of cash and cash equivalents into and out of a business during a specific period. Cash inflows indicate money received. Example, sales, loans taken, investments received, etc. Whereas cash outflows indicate money spent. For example, payments to suppliers, salaries, loan repayments, etc. Why it matters? Profit doesn't always mean cash in hand. A company may show profit on paper but still face cash shortages. That's why businesses track cash flow separately through a cash flow statement. There are three types of cash flow: operating cash flow, which is from regular business activities, investing cash flow, which include buying or selling assets or investments, and financing cash flow, which include cash flow from loans, shares, or repayments. The last term we look at here in this video is free cash flow. Free cash flow, or FCF, is the amount of cash generated by a company from its business operations after covering its capital expenditures. Thus, free cash flow is equal to operating cash flow minus capital expenditures. Investors and analysts look at FCF to assess a company's financial health beyond accounting periods. Positive FCF means the business can grow, reduce debt, or return value to the shareholders. Hope you have understood all the terms that we have discussed today in this video. With this, we come to the end of this video. If you find this video useful, please like the same and share it with your friends. Also, subscribe to my channel for many such interesting videos. If you have any question, please put your query in the comment section. Thanks for watching.